Are you a freelancer or self-employed wondering, can I really buy a property in Singapore without a fixed or stable salary? The answer is yes. Hi everyone, this is Kelly from Property Hunter Singapore and welcome back to our channel. If you're new here, don't forget to like, share and subscribe to our channel for more content on property investment, real estate trends and home buying tips. In today's video, I'll break down methods that freelancers or self-employed persons can use, such as pledge funds and show funds to take a loan, plus a secret hack to avoid the dreaded 30% income haircut that banks apply. You don't need a conventional 9-to-5 payslip to secure their home loan. You just need the right strategies. By the end of this video, you know exactly how to position yourself to get a home loan approved and take one step closer to owning your dream home. Before we dive into pledge and show funds, it's important to understand how banks access your eligibility for a home loan through something called Total Debt Servicing Ratio, TDSR. The TDSR is set at 55% for home loans in Singapore. That means that your total monthly debt obligations, including other loans such as car loans, credit cards, and the home loan you're applying for, cannot exceed 55% of your gross monthly income. But here's the tricky part. If you're self-employed or have a variable income, like many freelancers do, banks apply an additional 30% haircut to your income. That means they will only recognize 70% of your earnings, which can make it a challenge for many freelancers and business owners to meet the TDSR criteria. Let's take an example of how this works in practice. Let's consider Lisa, a freelance content creator who earns about $8,000 per month. Based on the normal 55% TDSR calculation, Lisa could potentially take up a home loan with a repayment of $4,400 per month. That is, if she has no other debt or loan and is a salaried employee. However, because she's a freelancer, a 30% haircut will be applied to her income. So instead of taking 55% of her $8,000 income for the TDSR, the bank will calculate the TDSR based on an income of $5,600 instead, which is 70% of her income after the haircut. That brings her TDSR down from $4,400 per month to $3,080 per month instead. So instead of being able to buy a $1.1 million condo, her loan eligibility now only allows her to be able to purchase a $800,000 property instead. And what if Lisa has already set her eyes on a $1.1 million property? What can she do to boost her loan eligibility in order to qualify for the purchase? First up is the pledge fund method. So what is a pledge fund? The pledge fund method involves pledging, which is keeping, your assets such as cash deposits or stocks and bonds to the bank for a minimum of 4 years. In exchange, the bank will grant you an extra loan amount based on the amount of assets you pledge. Take for example, if you wish to increase your loan eligibility by say $100,000, you will need to pledge an amount of $44,800 cash in fixed deposit with the bank for 4 years. So for Lisa's case, where she needs to increase her loan by $300,000, she will be required to pledge an amount of approximately $134,000 with the bank. Do take note that this calculation is based on the current bank stress test rates of 4.6%. Here's something you will need to take note of as well. Not all banks accept stocks and bonds for pledging. Some banks only accept certain types of stocks and bonds, and a haircut may still apply, depending on the bank's policy and the type of assets you hold. For example, a bank may apply a 30% haircut on certain stocks, meaning that they will only recognize 70% of the value of those stocks when calculating your loan eligibility. The exact haircut will depend on the bank and the specific stocks or bonds you have, so it is crucial to check with your bank about which assets they accept. Also, here's another tip that we learned from a seasoned mortgage broker. Even though you will need to pledge your funds with the bank for a minimum of 4 years, you can actually take the funds out 2 years later when you refinance with another bank. And if by then your income supports, you may decide not to pledge the funds anymore. I hope you guys are learning so far. Before I continue, please help me by liking or sharing this video. Okay, back to the topic. The other way Lisa can use to boost her loan amount is the show fund method. This method essentially requires you to show the bank your liquid assets such as savings, stocks, or bonds to prove your financial stability. The funds are usually required to be shown upon signing the letter of offer as well as during loan disbursement. However, do take note that the bank applies an approximately 70% haircut to these assets, meaning that they will only recognize around 30% of the value towards your loan application. So given the same scenario of wanting to increase your loan by $100,000, you will need to show your liquid assets of $149,200. That's about 3 times more than the pledge fund method. And of course, the different banks will have their own policies on the types of stocks or bonds that they will accept and the haircut rate that they will apply. A good thing to note is that banks are usually more accepting if the stocks or bonds are traded in their own platform. For example, you are trading using a particular bank's platform and you are taking a loan with the same bank. Showing funds is a great option for proving financial stability without tying your funds down. But keep in mind that the haircut significantly reduces the amount the bank will recognize. So you will have to show a lot more in assets compared to pledging. So if you're planning to use this method, make sure you understand how much of your assets will be factored into the bank's calculation. Very often, we do advise our clients to do a combination of both part pledge and part show instead. Now, here's a smart tip for you if you want to avoid the 30% haircut altogether. You will need to be under employment with CPF contributions and a company where you are not a shareholder. This way, the bank will treat you like any other salaried employee, assessing your full salary instead of a reduced amount. In conclusion, whether you choose to pledge or show funds or do both, these methods can help you increase your borrowing capacity as a freelancer or self-employed individual. But most importantly, you will need to be able to prove to the bank that you have a consistent income and your ability to service the mortgage loan. Keep in mind that pledge fund requires a 4-year commitment, while show funds come with a huge haircut, meaning you will need to show a much larger amount of assets to secure the same loan. Also, be aware that not all banks accept stocks and bonds for pledging, and even those that do may only accept certain types with varying haircuts. If you're unsure about which assets they do or don't accept, or if you'd like to find out more about other methods that you can use to boost your loan eligibility, do feel free to reach out to us and we'll see what our seasoned bankers can do for you. If you find today's video useful, please remember to give it a thumbs up and subscribe to our channel for more real estate tips and insights. Thank you for watching and I'll see you in our next video. Bye bye!